Are wind and solar subsidies back on the table? Next on the Energy News Beat Daily Stand-Up. The Senate caves on IRA wind and solar subsidies. This one is by the great friend of the show, David Blackmon, his Substack. Highly recommend checking him out. It's really interesting. I mean, if you go back and look last week, one of the big positives of the big, beautiful bill, outside of the fact that it would add $4 trillion to the debt. But one of the big positives of that bill was that they were really going to yank the wind and solar IRA provisions. And the version that was basically outlined by the Senate Finance Committee was very strict, or at least the one that got presented to the Senate Finance House Committee. The problem is the one that came out of the Senate Finance Committee basically sort of walked it back. So what specifically happened? So specifically, and I'm going to read straight from his Substack here, specifically, the Senate does away with the hard House provision that a wind and solar project must be placed into service by 2028, with softened language requiring only that developers, quote, begin construction on a site by 2030 in order to receive these subsidies. And to give you guys an idea, in reality, what does that mean? It means big oil and gas, big solar and wind companies like Ørsted, any number of these offshore wind and solar companies. All they need to do is make minimal down payments by 2030 to claim, quote, have started construction in order to then continue to receive the IRA subsidies and those tax benefits through 2040 without having to basically do anything and even like kick up a pound of dirt. Unfortunately, so unless there's amendments, that's what's going to happen. I mean, it's unfortunately not good, because you can rest assured, and I'll just read now straight from the article here. You can rest assured and you can be sure that in the 15 years between now and 2040, the wind and solar companies and their associations will most likely drafted this revised language and handed to a friendly rhino on the Senate Finance Committee, which will continue to spend millions of dollars with well-connected lobbyists on efforts to remove this absurdly soft fake deadline. He then goes to list out who are the people on the Finance Committee, and he does. I love this. He goes, if you're looking to rank likely rhino sellouts on this issue, I'd rank them as follows. Number 1, Texas Senator John Cornyn. Next, Oklahoma Senator and Chairman Subcommittee James Lankford, Kansas Senator Roger Marshall, and Montana Senator Stephen Daines. I love this quote. Senators Cornyn and Lankford are notorious wind shills, no less so shills for the solar industry. But it's pretty crazy what they want to do with this. I mean, basically, they're moving this deadline back in order to appease somebody. Who they're trying to appease? Well, obviously it's the wind lobby, and the wind lobby, which is funded by big wind, big wind, big pharma, big oil, they're all in there, big everything. But the point is, like everything that happens in reconciliation, we go for the moon and we end up somewhere down here. And to me, this is not good. You've got to go ahead and get that out of there, because everything needs to be on a level playing field. I cannot stand when people say, well, oil and gas has tax benefits. It has benefits. It does not have subsidies. Okay. What the IRA is subsidies. And there's a difference between a subsidy and a tax benefit. So if you want, call up your senator, make sure this doesn't happen. But, if this bill goes through, it may end up being where those subsidies actually stay in there. Next up here, dozens of U.S. states opposed to offshore oil and gas drilling goes ahead and files a complaint with the Bureau of Ocean Energy Management. So to give you guys an idea, there's a coalition of about 12 states who have petitioned that bureau, the BOE, to exclude Atlantic and Pacific Ocean planning from oil and gas leasing. There's the upcoming 11th National Outer Continental Shelf Oil and Gas Leasing Program. This is led by probably one of the largest oil and gas producing states, Maryland Attorney General Anthony G. Brown. That's a joke. Maryland literally has zero oil. This coalition is going to argue that offshore drilling threatens marine ecosystems, coastal economies, and state-level clean energy goals. So to give you an idea, here's the coalition. You got California, Connecticut, Delaware, Maine, Maryland, Massachusetts, New Hampshire, New Jersey, New York, Oregon, Rhode Island, and Washington. And drum roll, please, the only state that actually has oil and gas offshore is California. And we all know Oil Slick himself, Governor Gavin Newsom, is not going to be in favor of drilling. So you can maybe take out California, and we can talk a little bit later about how dumb they are. But I mean, all these other states, Connecticut, Delaware, Maine, Maryland, Massachusetts, New Hampshire, New York, New Jersey, New York, Oregon, Rhode Island, Washington. I mean, this is all just hand waving. It's a lot of what I do on this podcast, just hand waving with not much substance to it, because it's not like they were going to drill for oil anyway. And I think that's the funniest part about this. That's what your hard-earned tax dollars are going for. Okay, your hard-earned tax dollars are going for, if you live in those states, it's going for these hand-waving petitions that don't mean anything. It's not like Exxon's lining up to drill offshore New Jersey. It's not like they're lining up to do offshore Washington. I promise you, they're not. And so it's the only state that you could say is really shooting themselves in the foot. And if you listen to the show, you know exactly what state. It's California. I mean, they're the only state that actually has some offshore oil that theoretically could be drilled. Now, with the permitting, it wasn't going to happen anyway. Now, the fact that they want to go ahead and ban it, it's sort of like, okay, you weren't really drilling it anyway. There are actually 2 rigs offshore California. It would be dumb for California to do this, but they're going to do what California is going to do. It's a lot of hand waving, but I find it funny. Your hard-earned tax dollars are going towards banning oil and gas drilling offshore in Connecticut. So if you're Connecticut and you're in that 35% tax bracket, guess what? Your hard-earned money is going towards that. Let's jump over and quickly touch on some finance stuff, guys. Before we do that, let me quickly pay the bills. As always, thank you for checking us out. World's greatest website, w.energynewsbeat.com, the best place for all your energy and oil and gas news. Hit that link, the links in the description below for all the timestamps, links to the articles. Check us out, theenergynewsbeat.substack.com, a great place to, and kind of a great place, you know, to get going and learn about what's going on in the oil and gas business. We're putting a lot of stuff there that you can only find on our Substack. It's a lot of news and analysis. Highly recommend checking that out. If you sign up for a paid subscription, that would be great. And then also, guys, shout out to Reese Energy Consulting for supporting the show. You know, it's, if you're in the midstream space or in the upstream space and you need help in the midstream space, they work from everybody. They've got clients that are 2 guys in the garage all the way up to the largest publicly traded companies and everybody in between. ReeseEnergyConsulting.com. Let them know that Energy News Beat sent them. And finally, guys, if you're wondering if oil and gas is right for your portfolio, we have a great portfolio survey that you can hit in the link below, or go to investinoil.energynewsbeat.com. If you want to fill it out, we will get you a great ebook, and then depending on what it looks like, we will go ahead and put you in contact with some people that might be able to help you with that. Let's go ahead and look at the top line tickers, though. S&P 500 is flat. NASDAQ is flat. 2 and 10-year yields actually flat themselves. Dollar index was basically flat. I mean, the whole market was really flat on a day over day basis from that standpoint. We did see crude oil was up, you know, it was choppy today. It was down, it was up. We saw Brent oil up to 75.96, you know, 73.50. And then we did see natural gas up about 3.5 percentage points, you know, cooking at that $4 mark. So natural gas is continuing to climb. XOP, which is our E&P securities contract, is down about 0.3 percentage point from that standpoint. And then, you know, really the big thing that we saw today was oil was up again, you know, continuing on the, you know, Iran-Israel conflict. I mean, right now they're not targeting their energy infrastructure, but there is a chance that they do that. I think the real thing was that, you know, Iranian Supreme Leader Ayatollah Khamenei has outright rejected U.S., you know, Donald Trump's demand that for an unconditional surrender. Trump did say his patience had run out, but did not really come out and say what he's going to do next about that. There is a chance that the Strait of Hormuz becomes a choke point. And, you know, quote that came out of ING this morning is, quote, the biggest fear for the oil market is the shutdown of the Strait of Hormuz. If they decide to do that, oils could go as high as $120 a barrel, which would be unbelievable. The other very interesting thing that we saw today was the U.S. Federal Reserve. We saw a a little note out and a little press conference by Jerome Powell, who basically decided to hold interest rates steady today, so no cut. And, while they did signal that borrowing costs are likely to fall, they have kind of tempered the overall pace of expected future rates cuts in sort of what they're saying what they're faced with, they believe, is higher inflation that's coming from the tariff plan. They said that there still is a 0.5 percentage rate cut expected this year. They're slightly lowering their pace to a single quarter rate percentage point each of 26, 27 in a protracted, what they're calling, fight to return to inflation back to their 2% target. We did see a crude oil stocks drop by 11.5 million barrels, which was unbelievable. There was an expectation of a 1.8 million barrel draw. So absolutely unbelievable when it comes to that. And the market, didn't really do anything. So that's the funny part. Sometimes it's physical supply demand. Other days it's geopolitical. Today is a geopolitical. But that's really all I've got, guys. Nothing too much. We appreciate you sticking with us all this week. You will hear a long form podcast tomorrow. Check out, I will actually be running today. If you're listening to this, there will be a great article out on our Substack on what to look for if you're looking to invest in oil and gas, kind of a cheat sheet of what you need to look for, signs, questions, all that good stuff. So check that out, theenergynewsbeat.substack.com. But with that, guys, we're going to go ahead and let you get out of here. Finish up your week. Thank you for sticking with us. Like I said, you'll hear our long form interview tomorrow. You'll hear our weekly recap on Saturday. We will take Sunday off and be back in the chair Monday, bright and early. Thanks for checking us out, guys. For Stuart Turley, I'm Michael Tanner. We'll see you tomorrow, folks.